graph that display the graph, the relationship between come to maturity and time to maturity, which is called as the term structure, right? So even if there are a lot of the theories, but in this financial management class, we will cover just only one theory, that is basic and fundamental hypothesis to explain the relationship between yield to maturity and time to maturity, graphed in the yield curve. So in last class, we talked about the basic assumption of pure expectation hypothesis. And pure expectation hypothesis assumed that before that, there are two announcements. First one is I will upload the first homework in the e-class. The due date of the first homework is next coming Thursday, right? That's the first announcement. Second announcement is you are supposed to take the first quiz next Tuesday, okay? Quiz next Tuesday. So as I explained in the first class, when I explained the syllabus, the quiz has, you have 5 questions within the 10 minutes. So 3 out of 5 are related to the review questions, and 2 out of 5 is associated with the preview questions. So I will let you know the coverage that we will do on coming Tuesday at the on the last part of this class. Okay, so the quiz, you're supposed to take quiz just within the 10 minutes. So all of the quiz are associated with the essay questions, and the homework is related to the type of the calculation questions. Okay, all right. Any question about quiz and first homework?
Professor, I just had a question concerning the final exam. Do we need a big calculator?
You said final exam?
Yes.
Yeah.
Okay.
Okay, keep going. Yeah.
Which kind of calculator do we need? It's only addition, because I have
So
to.
you're asking the date to take the final exam?
Yes.
Yes. So we already set the final exam day, December 4th.
Okay.
Yeah, December 4th.
Okay.
Midterm exam will be conducted on October 16th.
Okay. Okay.
Right.
Okay. Thank you.
I also have a question. Sorry for interrupting. Are we allowed to use Excel during the exam?
I'm sorry?
Are we allowed to use Excel?
Yeah, sure. Exactly. Yeah, sure. You're correct. Yeah.
Okay. Yeah.
So you are using the Excel spreadsheet when you take the exam. So that's why I explained how can we figure out some of the questions by using Excel spreadsheet during the class. Definitely, yeah, you can do that. Any other question? All right. Please turn on your camera, Mark.
Sorry, I have one more thing actually.
Yeah, sure.
Because I've been going through your slides and I've seen that there are a lot of examples that are basically exercises. However, there are no solutions on the slides. I know that you usually do them during class, but like now that I'm repeating the classes, I just don't have the solutions. So I don't know whether or not what I'm doing is actually correct. So I was wondering if you could post the solutions as well.
Oh, as long as I remember, all of the answer is in the slide, but I'm not sure what kind of question did not provide the solution of the questions in my slide. I think the most of the question I provided most of the solution about the questions, but I'm not sure what kind of question I didn't provide the solution. So if you want to know that, then just email me. Okay. All right.
Okay. Yeah. Thank you.
Any other question? Okay. Right. So let's take a look at the assumptions of the pure expectation hypothesis now. So we assumed the maturity risk premium to treasury securities is 0, which is the illogical the assumption, because as we already talked about each risk premium on each different bond. Okay, so we already talked about this issue. So from now on, I will explain the topic with the long-term treasury security, long-term treasury bond. Long-term treasury bond can be issued by the government, right? So based on the study in the last class, long-term treasury bond has the inflation premium and maturity risk premium, right? So because this is a long-term, so even if this bond issued by government, we need to ask the maturity risk premium, right? But to explain the yield curve by using pure expectation hypothesis, we ignore this maturity risk premium. Okay, so we can explain pure expectation hypothesis by using inflation premium to explain the yield curve. Okay, which is the most crucial flaw in pure expectation hypothesis. Okay, so basically the long-term government should have the inflation premium and maturity risk premium. But if you want to explain the yield curve by using pure expectation hypothesis, we can only use inflation premium. We don't have to use the maturity risk premium. Okay, which is the the limitation of pure expectation hypothesis, right? So we assume the maturity risk premium is 0, which is the illogical, unreasonable. But according to by definition, the pure expectation hypothesis explain the relationship between term to structure and yield to maturity. The yield to maturity and time to maturity with the only inflation premium. Okay. So the pure expectation hypothesis, in pure expectation hypothesis, we would say the long-term rate are an average of a current and future short-term rate. So the current interest rate times the future short-term interest rate is going to be long-term interest rate in pure expectation hypothesis. So if the pure expectation hypothesis is correct, you can use the yield curve to estimate the expected future interest. So we already figured out the yield curve shows relatively generally upward, right? This is yield curve. X-axis is the time to maturity, y-axis is the yield to maturity. Okay, so this is 1 year maturity bond, 2-year maturity bond, 3-year maturity bond, 4-year maturity bond, for example, issued by same the entity, in this case, the government, right? So we are talking about the pure expectation hypothesis using treasury bill, long-term treasury bill. Then each figure in yield curve is what? Spot rate. Spot rate. Spot rate means that we can estimate the yield to maturity as of today. At this point, we can estimate the yield to maturity on each different maturity. right? Bond with different maturities, which is called as spot rate. The reason why we would say spot rate is because we can estimate the yield to maturity on each, the bond with the different maturities at this point. So we'll say the spot rate. So interest rate or yield to maturity within the yield curve represent the spot rate, okay, not forward rate. On the other hand, so we'd say, let me show you, for example, let's say we have 5 years maturity, okay, 5 years, duration is 5 years. Then we can estimate the treasury bond whose maturity is 1 year. So that yield to maturity can be expressed by YI. Okay, YI is my last name, YIE, right? YI is my last name. Why not YI, Y1, okay, Y1. How about yield to maturity of treasury bond with 2 years maturity? That's the Y2. How about the yield to maturity of bond whose maturity is 3 years is Y3? How about the 4 years? Y4, Y5, right? So be careful. This interest rate, Y as Y, what interest rate should be expressed by per year concept, right? Per year. So Y1, Y2, Y3, Y4, Y5 present the return or yield to maturity per 1 year. Okay, so if we will say Y2, this is a 2 years return, right? Then 1 plus Y2 square is the total return during next 2 years. Okay, but we can express the Y2. Y2 is the unit of per year. Okay, so don't be confused of the total return and the return on per year. Okay, so this Y1, Y2, Y3, Y4, Y5, we can estimate through Y1 through Y5 at this point as of today. So all of this Y is called as spot rate. So yield curve is the combination of all spot rate. Okay, then you wonder what is interest rate, yield to maturity or interest rate during from the first year and second year. What is the second year from second year to third year? What is the from first year to third year? There is some the interest rate, right? Those kind of interest rate we cannot estimate at this point, right? Because this interest rate start from the near future, some day in the future, right? So this rate is called as forward rate, because this rate cannot be estimated as of today. Okay, so forward rate is expressed by F. So for example, forward rate from the first year to second year is 1F2. We can express just like that. Forward rate from 2 year and to the 3 year, third year is 2F3. How about the forward rate from the first year to third year? 1F3, just like that, right? So we can express just like the the interest rate or yield to maturity. Then we can express 1 plus y, for example, 1 plus y3. Definitely, this is the yield to maturity of treasury bond with 3 years maturity, right? Total return is expressed by 1 plus y3 to the power of 3, right? Can be expressed by 1 plus y1, right? Times 1 plus 1f2 times 1 plus 2f3, right? So the multiplication 1 plus y1, 1 plus 1 f2 by 1 plus 2 f3 is going to be 1 plus y3 to the power of 3. All right. This is the forward rate, spot rate. Okay. This equation can be expressed by another way. 1 plus y2 square times 1 plus 2f3. Or we can express in different way. 1 plus y1 times 1 plus 1f3 square. Okay, so once you know the yield to maturity on every year, once you know the yield to maturity on every year based on the yield curve, you can estimate the forward rate, right? Forward rate. So if we ignore the maturity risk premium, so we are explaining the yield curve by using only inflation premium, then we would say why yield curve is upward, because forward rate is higher than spot rate, then yield curve shows upward, as you can see. Okay, as you can see, right? So here you go. The example: observe treasury rate and pure expectation hypothesis. If it's the treasury yield curve of treasury bond, right? With 1 year maturity, 2 years maturity, 3 years maturity, 4 years maturity, 5 years maturity. As you can see, 2 years maturity treasury bond whose maturity is 2 years, yield to maturity is higher than the 1 year maturity treasury bond, right? 3 years treasury bond yield to maturity is higher than the 2 years treasury bond. 4 years treasury bond yield to maturity is higher than the 3 years the treasury bond. Why? Because why this one is higher than this one, this one is higher than this one, this one is higher than this one? Because the forward rate is higher than spot rate. That's the pure expectation hypothesis. Okay, so let me show you very basic example. So let's take a look at the page number 253. To illustrate the pure expectation theories, third paragraph, page number 253. Assume that a 1 year treasury bond currently yield 5% and a 2 year bond yield 5.5%. Investors who want to invest for 2 year horizon have two primary options. Okay, so you have the plan to invest in the bond during last 2 years, 1 year, 2 years. So you have planned to invest your money in treasury bond in 2 years. Okay, then there are two options. You can invest your money during 2 years, right? 2 years at one time. That's the first option. What is the second option? You can invest your money in the bond, treasury bond with 1 year maturity. Okay, and then after you receive principal and interest after 1 year, then you can reinvest your principal and the interest for the 1 year. So this is a repeat. You can repeat invest 1 year bond, right? You can do you can invest your money with the 1 year maturity two times. Okay, that's the second option. Right, the first option is that you can invest your money in next 2 years. Second option is that you can invest your money on one year twice. Right, that's the first option and second option. And yield to maturity of the 1 year bond is 5%, and the 2 years bond is 5.5%. Okay, then what's this? That's the question. Okay, so basically we assume that either way the total return is identical, right? Either way the total return is the same thing. If we assume just like that, okay, then what is the full rate from the first year to the second year? Let's calculate. Okay, then this is the y1 is 5%, y2 is 5.5%. So 1 plus y2 square is going to be 1 plus y1 times 1 plus 1f2. So 1 point y2 is equal to 5.5%, 0.55 square equal to 1 plus what is y1? 5% times 1 plus 1f2. If you calculate this one, then 1f2 is going to be 6 point, about 6 point. Okay, then is the workaround, right? It's proven. See, this interest rate 6%, right? Why yield curve show the just like the 5% 1 year, 2 years 5.5%, second year to 2 years. Then why yield curve shows just like upward? Because why? This forward rate from the first year and second year higher than 1 year maturities, yield to maturity, 1 year yield to maturity, yield to maturity of the 1 year bond. 6 is higher than the 5. That's why yield curve shows upward. That's the the explanation, the procedure, mechanics of the pure expectation hypothesis, right? Then what happens if the yield curve shows negative and the downward? Then why this yield curve display the downward? Because forward rate, if forward rate is the less than spot rate, forward rate is less than spot rate, then yield curve shows the downward, according to the pure expectation hypothesis. Right? So let's go back to the previous slide. Okay, so there are two questions. If the treasury bill, treasury bond provide those kind of yield from the first year, the maturity through the 5 years maturity, then if pure expectation hypothesis hold, what does the market expect will be the interest rate 1 year security 1 year from now? That's the first question. The second question is 3 year security 2 years from now. There are two questions, right? So first one is 5 years. We have the 5 years yield to maturity information, right? So the first question is what was the first question? First question is the 1 year security interest rate 1 year from now, right? So the first question is asking 1F2. So the maturity of the bond is 1 year, and then you expect that security, you can buy that security on 1 year from now. So first question is asking 1F2. How about the second question? Second question is 3 year securities. So maturity duration is 3 years. When? 2 years from now. So second question is 2F5. Second question is asking the 2F5. So if you face the questions just like the time value of money, you need to figure out what kind of question is what type is what kind of question is asking what type, right? So first question is asking 1F2. Second question is asking 2F5, right? Then here you go. So we already know the information of first year. This is Y1, Y2, Y3, Y4, Y5. So how can you calculate the 1F2? 1 plus Y2 square is going to be 1 plus Y1 times 1 plus 1F2. We are looking for this 1F2 variable, right? So 3 variables, and we know the two variables value, right? So Y2 is 6.2%, Y1 is 6%. Okay, so we can calculate the 1F2 just like that. So this is the 1F2, right? 1F2 is the 6.4%. So this 6.4% is higher than 6%, so yield curve shows upward, right? How about the second question? Second question is this one, right? So the yield to maturity of the treasury bond with a 5 years maturity is 0.5%. And the yield to maturity of treasury bond with a 2 years maturity is 6.2%. So we are looking for this kind of interest rate, yield to maturity. This is the expressed by 2F5, right? So this one is 1 plus Y5 to the power of 5 equal to 1 plus Y2 square times 1 plus 2F5, 1, 2, 3 years to the power of 3. Okay, then the yield to maturity of 5 years treasury bond is 6.5%, 6.5%, and the yield to maturity of 2 years bond is 6.2%. Okay, then 1 plus 2F3 to the power of 3 equal to 1.065 to the power of 5 divided by 1.062 square. So 2F3 equal to 1.065 to the power of 5 to the, divided by 1.062 square to the power of 1/3 minus 1, right? This is a plus 1, right? So we can calculate the 2F3. So if you calculate just the calculus, then this 2F5 is going to be 6.7%, right? This is the the explanation way by using pure expectation hypothesis, just using the inflation premium, not the maturity risk premium, right? So you should be good at the those kind of the questions, right? The conclusion about pure expectation hypothesis: some would argue that maturity risk premium is not equal to 0. Not some, not some. This is the true, right? Because we already assumed that we already figured out, right? So the long-term security has maturity risk premium, but to explain the yield curve by using pure expectation hypothesis, we ignore maturity risk premium, right? So that is gonna be very big limitation flaw. Okay, so pure expectation hypothesis may be incorrect. Okay, so we will talk about the other theories to explain yield curve, but which are relatively complicated. So in financial management level, the introduction level, we only deal with the pure expectation hypothesis, even if pure expectation hypothesis has a crucial limitation, right? So most evidence support the general view that lenders prefer short-term securities and view long-term securities as riskier. Thus, investors demand a premium to persuade them to hold long-term security due to the maturity risk premium. So in reality, if we explain the yield curve by using just only inflation premium in pure expectation hypothesis, then if we draw the real yield curve, then generally real yield curve is located above yield curve based on the pure expectation hypothesis. This blue one is real yield curve. Red one is yield curve by pure expectation hypothesis. Okay, so this amount can be explained by maturity risk premium in reality. Okay, in reality. So even if there's some crucial flaw, pure expectation hypothesis is the most common theory to explain the yield curve. Because I mean by using only inflation premium, ignore the maturity risk premium. So if we consider maturity risk premium, then real yield curve is located above, just like the yield curve, by using the pure expectation hypothesis, right? This is the conclusion about pure expectation hypothesis, right? And the last topic is the macroeconomic factors. Other factor means macroeconomic factor. Macroeconomic factors to affect the interest rate levels. So in this chapter, we have talked about 3 factors, right, to affect the interest rate. First one, there was no the slide, but first of all, we figured out cost of capital, right? Cost of capital from the point of company, right? From the point of company. So there are some the factors to affect the cost of capital. For example, production opportunity or something like that, right? That's the first factor we talked about. Second factor is determinant of market interest rate, which is the genuine, right? So the second one is we already figured out, this one, okay, determinant of interest rate. Okay, so there are second factors to affect the interest rate. And the last one is the other factor is macroeconomic factor. Macroeconomic factor that influence the interest rate level. So don't be confused of the factor. There are 3 factors, 3 different factors to affect the interest rate. First one is we talked about cost of capital. Second one is the determinant of market interest rate. Third one is macroeconomic factor, right? So there are 4 factors: Federal Reserve policy. Federal Reserve play a role as central bank. The Federal Reserve policy, federal budget, the surplus or deficit, international factors, and level of business activity. Let's take a look at one by one. So Federal Reserve policy is how can the interest rate level is changed if we consider the Federal Reserve policy by using supply curve and demand curve. X-axis is dollar, y-axis is the interest rate, right? So as you can see, this is supply curve and demand curve, supply and demand, right? So if Federal Reserve policy, so if Federal Reserve increase the money supply, 통화정책 increase money supply, then supply curve now shift to the right way, right? So as from S0 to S1. If the monetary policy, if the Federal Central Bank or Federal Reserve increase money supply, then interest rate level is decreased to I1, right? Interest is decreased, right? On the other hand, if the Federal Reserve decrease the money supply, then supply curve now shift upward to the S2, right? From the S0, then interest rate is increased, right? Interest rate increase. That's the first factor. That's the first macroeconomic factor to affect interest rate level, right? Second macroeconomic factor is federal budget surplus or deficit. Federal budget surplus. Federal budget means the expenditure. We can compare expenditure by government and the tax revenue. Right. So basically government spend a lot of money, right, to, for example, construct some railroad, some house, to give some guy as a welfare, right? So the government spend a lot of money, and main resources of the money is what? Tax. Okay. But most of the company is struggling with what? I don't have enough money, right? So expenditure is always generally exceed the tax revenue. This situation is called as federal budget deficit, right? Federal budget deficit. 모자른 거야, 그렇죠? Not enough. Okay. Then what happened? If government is struggling with the money, then what should the government do? Government issue the bond, right? Government bond to raise a fund. Government doesn't have any money, right? So to raise a fund, government cannot but issue the bond. Then if the government issue the bond, then what happened in terms of the money supply, money in the market? Observe the money, right, from the market to the government. If the government issue the bond, then observe the cash, right? Cash can be moved from the market to the government, right? Then what happened? Money supply is decreased from S0 to S2, right? Then what happened in terms of interest? Interest is increased. That's the second factor, second macroeconomic factor to affect the interest rate level. Third one is international factor. International factor is what? International factor is all about trade. Trade, export and import. You see Korean is most representative country with a trade, right? So the total amount of export and import in Korea is, I'm not sure, 7th ranked in the world or 8th ranked in the world. So we would say 한국은 수출 수입 값 먹는 나라죠. The representative country of trade in Korea. So if export is bigger than import, then what happened? The fact that export is higher than import, then cash inflow from the foreign countries to the Korea, right? So cash flow move from the other country to Korea. If export is higher than import, then money supply is what? Increase to S0 to S1, from the S0 to S1. So if the country's export is higher than the import, then interest rate is decrease. Right? That's the third macroeconomic factors. And last macroeconomic factor is level of business activity. Level of business activity is all about what? Economic cycle, right? Cycle of economy, 경기순환, economic cycle. So let's say now is the the recession stage. So we'll say economic life cycle is recession, bounding or through, and expansion, and through and decline, right? So that's the 4 stage of economic cycle. So if we say that now current economic cycle is in the recession stage, then if current economic life cycle is the recession, then companies don't want the money, right? Because why? Even if company produce a lot of goods, but nobody can buy those kind of the goods because the economy is recession stage. Then the money demand is decrease, right? So the demand curve shift to the left side from D0 to D1, and the interest rate is decreased from I0 to I1. Furthermore, government want to boom the economy, right? So government, the financial authorities increase money supply. If the economy cycle is in the recession stage, then S curves, money supply curve, shift to the right hand side to S2 from S1, and interest rate is set by I2. So interest rate decrease from I0 to I1 due to the demand decrease. And furthermore, interest rate is more decrease from I1 to I2 due to the increase of money supply, right? So interest rate level now is changed twice from I0 to I1 to I2, okay, which is another macroeconomic factor to affect the interest rate level, right? So we have talked about 4 macroeconomic factors to affect the interest rate level. So far we have dealt with 3 kinds of the factors to affect the interest rate level. First one is from the point of the cost of capital. Second one is determinant of market interest rate. Third one is the macroeconomic factor to affect the the interest rate level. Right? Any question? No? Okay, before we close this chapter, there's a very popular now, there's the hot issue is tapering. Why is tapering? Why is tapering? This is a tapering. Nobody laughing at. Taper. What is tapering? 준서, tapering 뭐요? If you read a newspaper or internet now articles, there are a lot of the tapering article there. 어두워. So dark. So if you take a look at the article, especially in economic session or financial session, you've you've seen the terminology of the tapering. What's that? 준서. 테이퍼. tapering. 이거 들어봤잖아. You've heard about it, right? tapering. 안 들려. I cannot hear you. 안 들려. 다른 사람 들려요? Can you hear? No. 안 들린다.
Hello?
Oh, yeah. Now I can hear you.
Can you hear me? Okay.
Yeah.
Definition I know is that tapering is cutting off at the end.
Cutting off what? For what? Cut off for what? Cut off for what? 그냥 cut off 해? Cut off? Virginia, what is tapering?
I don't know, honestly.
You don't know? You don't know me? You don't know me?
Maybe joining something together? I don't know.
Joining is some distance of the correct answer. 태진, 송태진.
Yes, professor.
Yeah. What is the tapering?
I'm sorry, I don't know.
After this class, you try to find the article with the tapering. Okay, there's very I mean many articles there, right? So tapering means before we talk about tapering, you need to know the QE. QE is quantitative easing. Quantitative easing. QE. So before we talk about tapering, you need to understand the QE. Tapering is the reversed concept of the QE, quantitative easing. First of all, quantitative easing means the 양적 완화 in Korean, which means after global financial crisis happened 2008, global financial crisis, GFC, we would say GFC, global financial crisis 2008. There were the very risky in the financial market as well as the asset market. So many countries, including the US, European countries, provide a lot of the liquidity to the market, which means that they financial authority, the government, increase the money supply, right? After global financial crisis. And then furthermore, COVID-19, due to the COVID-19, there's some very risk in the asset production market or the asset market. So the many countries, the provide a lot of liquidity as well again. Okay, so as you experience current apartment price, current stock market price, stock price goes up dramatically, historically. Because why? There are tons of money around us. 근데 you don't have any money, right? There are tons of money around us, but where is my money, right? Anyway, so there are a lot of the money around us. So the asset price goes up dramatically, which is what? Just like bubble, right? Bubble. So many guys, make a lot of the money, but a lot of part of their welfare, the asset is what? Liability. Right? Liability. Okay, so which is the sort of the bubble. So we are now worrying about inflation now, right? Inflation. So the price on many items goes up, goes up, goes up. So we are worrying about the inflation. Then what should the government do? What should the financial authority do? Now it's time to observe liquidity in the market, which is called as tapering. Okay, the exact that is not exact explanation, but you can understand just like that. So quantitative easing means to provide a lot of the money supply, whereas the tapering is to observe the liquidity. So nowadays, the U.S. government as well as Korea, so one of the way to observe the liquidity is what? Increase interest rate, right? Increase interest rate. So nowadays, a lot of the financial authorities start to try to increase interest rate. Then what happened? If you borrowed a lot of the money, then you should repay the interest more and more and more and more, right? So which is, we'll say, that's very risk. Okay, so the tapering. So now tapering is very hot issue nowadays. So as I explained, so the for example, market price, stock market, we'll say goes up, right? This is the common thing because the industry or company generally grow. So the stock price goes up. That's the common sense. But this stock price, we have the cycle, right? So the basic trend is upward. But the stock price sometimes goes up, sometimes goes down, goes up, goes down. But the basic trend is upward. Okay, but during the last 10 years after 2008, and according to the history, we have all this adjustment during on 10 times, on every 10 times. Okay, but after 2008, stock price goes up continuously. There was no adjustment stage. Okay, so if you say, all right, it's okay if goes up, continuously goes up, then let's say this is the basic trend. Let's assume. Then in the past, stock price goes up, goes down, goes up, goes down, goes up. So this cycle is 10 years, on every 10 years. Okay, but after 2008, stock price continuously goes up. So we say this is the one bubble as much as this amount, right? So if this stock price converges to the basic trend, then impact is huge. So many the officers worry about this kind of if this kind of situation happen, then a lot of the investor go to the Han River. Han River is Hangang, right? Why? Right? To die, right? Suicide, right? So many financial authorities now they worry about that kind of things, especially individual liability level, individual liability level, 가계부채, household liability level is dramatically increased now here in Korea. Okay, so even if we say apartment price is the $3 million, $2 million, but many of experts said 50% of $3 million is a bubble, because all of things is liability. right? So I think it's time to adjust those kind of the cycle. So the starting point is the tapering, right? Tapering. So as I told you in first class, we have covered a lot of topic in the financial management, but that is not enough to understand the happening in the real economic, the situation, right? So if you wanna understand in more detail, especially in the real the situation, so I strongly recommend that you need to read the financial press. Okay, please read the financial press. So if you read the financial press, there are a lot of the articles about the tapering. Okay, so I strongly recommend you need to be interested in what happened in the financial market or the asset market, or including the economy, right? Okay, that's it. Any question? Right. Well, let's move on to chapter 8, risk and return. Right, risk and return, chapter 8 is another most basic, fundamental, important, crucial chapter in the financial, the financial management. So as I told you, time value of money and risk and return are most important, crucial, fundamental, basic topic covered in financial management, right? So it's very important thing. But then logic is very simple. High risk, high return. That's it. High risk, high return. That's it. Okay. So before we start with chapter 8, let's take a look at the putting things in perspective. So what kind of topic we should cover, we should talk about in this chapter? Okay, so let's take a look at the page number 271, putting things in perspective. We start with this chapter from the basic premise that investors like returns and dislike risk. That's common, right? All of the human beings like returns, dislike risk, right? Hence, they will invest in risk assets only if those assets offer higher expected returns. So you have two options. You can invest your money in risk-free asset, or you can invest your money in risk asset. Then why you are willing to invest your money in risky asset? Because you can make the more money. You can make the more return comparing to investing in the risk-free asset, right? That's the reason why we invest our money in risky asset to get the more money, which is the line with the high risk and high return, right? So we define what risk means as it related to investment, examine procedures that are used to measure risk, and discuss the relationship between risk and return. So as you shall see, it's very easy to figure out the return, but the risk is really complicated. So as I told you in several times, there are tons of risk and there are tons of measure and the estimation measure to estimate the risk, right? So in finance, especially before that, the risk can be defined as the degree of deviation of expected return, right? As you shall see in finance, especially. So before we invest, we expect the return, right? Which is called the expected return. So before we invest, we can estimate the return, which is the expected return, not realized return, right? We do not know because that can be happening in the future. So when the time we invest, we only can estimate the expected return, right? But it's not necessarily that our expectation is realized, right? So that's the common, right? So realized thing realized thing generally is deviated from the expected thing. Those kind of the differences, those kind of the gap can be measured by risk. Okay, so in finance, those kind of the big gap between realized thing and the expected thing, expected return and realized return is considered as risk. Then how can we estimate the risk? What kind of method, what kind of way to use to estimate the risk? That's going to be standard deviation. Standard deviation, as you shall see, standard deviation. So there are many methods, there are many ways to estimate the risk in several disciplines, but especially in finance, we can use the standard deviation to estimate the risk, right? So risk can be measured in different ways, and a different conclusion about an asset's riskiness can be reached depending on the measure used. So number 1 to number 7. Number 1, all business assets are expected to produce cash flows. So in finance, cash flows is the most important thing. All business assets are expected to produce cash flow, and the riskiness of an asset is based on the riskiness of its cash flows. So the same logic, right? So when I explain the risk, I use the return, but in textbook use what? Cash flow, right? So we can expect some cash flow, right? So why we invest our money? To get the more cash, right? So we expect some amount of cash flow, but the realized cash flow is totally different from the expected cash flow. The differences between expected cash flow and the realized cash flow can be referred to the risk. Okay. Number two, assets can be categorized as financial assets. So from now on, we use the financial asset. The other one is the stocks risk can be considered in two ways, on a standalone risk and the portfolio risk. Okay, so standalone risk is if we invest your money in just only one asset, single asset. But we prefer to construct portfolio more than two assets. Why? As you shall see, why we construct portfolio, which means why we invest our money not in one asset, but in several assets, several stocks, to reduce risk. Okay, so main purpose to construct portfolio is not to make the more money, more return, but to reduce risk. Okay, to reduce risk, we construct portfolio not to increase the return, okay, but to reduce risk, we need to construct portfolio, right? And number 4, in portfolio context, the stocks risk can be divided into two components: diversity risk, which can be diversified away, and the market risk, which is very important thing as well. So as I told you, the reason why we consider portfolio to reduce the risk, but risk can be divided by two: diversity risk, market risk. Okay, so even if we construct portfolio with 10 assets, 20 assets, 100 assets, 1,000 assets, market risk cannot be eliminated. Okay, then what kind of risk can be reduced? Diversity risk can be reduced when we construct portfolio. Okay, then let me see again. Why we construct portfolio? To reduce risk, especially diversity of risk. Okay, as you shall see, right? Number 5, a stock with a high market risk must offer a relatively high expected rate of return. High risk and high return, right? Number 6, if investors on average think of stocks expected return is too low to compensate for its risk, they will start selling it. Okay, so number 5. Oh, okay, number 5. If the stock with a high market risk must offer a relative. So nowadays, if the some stock is the very expensive, then many investors now sell that kind of the stock, right? Then expected return is gonna be increased. That's which is number 6. Number 5 is the reverse way, right? So stock with a higher market risk must offer high expected return to attract the investor. Investor in general averse to risk. Okay, yeah. Number 7 is stock analysis. We will see stock analysis. Okay, so we will talk about those kind of the topic in chapter 8. So in this chapter, we will talk about the standalone risk. Standalone risk is the the risk of single asset for single asset, one asset, single asset. Portfolio risk is the multiple assets, right? More than 2 assets. And we can figure out the risk and return by using CAPM and SML. CAPM is one of the asset pricing model. Asset pricing model is a model to explain the relationship between risk and return. Okay? So everybody knows now high risk, high return, right? That's the relationship between risk and return. Then how much the risk is related to return? How much? So we can figure out those kind of the relationship between risk and return by using asset pricing model. In reality, there are more than 1,000 asset pricing model. 진짜 많아. 열나 많아. 네? 진짜 많아. Really 많아. So many asset pricing model. Okay, but in financial management level, we only deal with CAPM. CAPM stands for capital asset pricing model. So asset pricing model, more than 1,000 asset pricing model. So in the doctoral program, so we study the asset pricing model. Asset pricing model is one of the most popular topic covered in the doctoral program. Okay, asset pricing model. So CAPM. The reason why we deal with the CAPM is because CAPM is the Bible of other asset pricing model. See, as you can see, CAPM has a lot of limitations, just like PEF, the pure expected hypothesis. But the reason why we study the CAPM is because CAPM provides the intuition of asset pricing model to other asset pricing model. So this is the original first asset pricing model. That's why this was developed in 1960. Before I was born, right? 1960, right? And the guy who developed the CAPM, all of guy who developed the CAPM got the Nobel Prize in economic area. 졸려? 정욱 씨 졸려? 정욱 씨 졸려. It's dizzy, yeah? Sleepy. Okay, 거의 끝났어. It's almost done, right? So we will talk about the CAPM, capital asset pricing model, to explain the risk and return. Okay, and SML stands for security market line. 원래 내가 잘 써요 글씨를. Originally, my writing is well organized, but this is the computer looks like very 못 알아보겠지, 그렇지? security market line. security market line. So SML is the line to explain the CPM, as you shall see. So we will talk about the CPM and SML, and beta coefficient is the key factor of CPM. So we will talk about those kind of topic. Okay. So what is the investment risk? So we'll say the standalone risk and portfolio risk. Okay. And before that, if you take a look at the figure 8.1, let me explain the risk and return trade-off more detail. Figure 8.1, there are two panels, right? Panel A and panel B. Panel A is talking about individual investors' perspective. Panel B is the company, the company's perspective. So both of them, x-axis is the risk. From now on, x-axis is a risk. Risk is expressed by standard deviation, the sigma. This is risk. Y-axis is expressed by expected return. This is individual, panel A, and panel B, risk, expected return. So there's the risk return trade-off line here, right? So this is the positive relationship between return and risk. If the line is just like that, then this is a reverse way, right? Negatively related to each other. Okay. So if the graph shows just like this one, positive slope, then we would say the expected return and risk has the positively related to each other. So for example, if this is expected things, right? So if some investment opportunity has this kind of the return with this kind of the risk, then according to the expected line, then it's okay if we enjoy this return R0. But if we consider this project A investment opportunity, then definitely R1 is higher than R0, right? So investment opportunity located in this area is good investment opportunity, right? Whereas if investment opportunity is located here, then the standard risk is as much as this amount, but the expected return is R0, but we can have R2 as return. So the investment opportunity located in this area is bad investment opportunity, right? By the same token, the same thing. A company from the perspective of a company, same thing, right? And this slope, the relationship slope, is totally depends on what? Investors' risk attitude. This slope can be determined by investors' risk attitude. Some of investors want to more if if you have the 1 unit of risk, let's compare A and B, okay? Then if you take the 1 unit of return, then according to the line B, you want to return as much as this amount, right? Right? How about the A? Line A, with the same risk amount increase, okay? But the amount you want to have the return is just like that one. Okay, so 2 is bigger than 1. So we would say if the line is steeper, that's gonna be risk averter, more risk averter, right? By the same token, right? By risk averter. That's the figure 8.1. So there are 5 items here. The probability distribution, expect, oh, time's up. Okay, let me stop here. And, you know, as I told you, quiz has a component of 5 questions. 3 out of 5 are related to review questions. So from the first chapter and, you know, until we cover today, that's the 3 questions. And 2 questions can be extracted from the what we will cover in that day, next Tuesday. Okay, so I will let you know the, you know, coverage we will, you know, the range that we will cover on coming Tuesday on e-class. Okay, so you should study the range that we will talk about on Tuesday. Right? That's the 2 questions. All right. Any question? So the 3 out of 5 are previous question. 2 the review questions. 2 out of 5 are previous questions.
Professor?
Yeah.
I have a question for midterm exam. How many questions will be there?
I don't know. I didn't make the midterm exam yet, so nobody knows.
Okay.
I will let you know the type and, you know, the number of questions about the midterm exam before we take the midterm exam. I will let you know the information of the midterm exam.
Okay, thank you.
Any question? No question? Then bye.